Chapter 12, Ratio Analysis. In this chapter, we'll apply everything we've learned so far. Using just basic math and the financial statements, we'll analyze a real company, just like Wall Street does. Let's get started. What we have covered in our course thus far. 1. We learned about the 3 financial statements. 2. We demystified debits and credits, establishing 6 possible outcomes as possibilities for all accounts. 3. Prepared a set of books using the accounting cycle. 4. Learned the difference between cash flow accounting versus accrual basis accounting, massively important. 5. We are learning the language of business. We think it is exciting to have come this far in just a few hours. The best is yet to come. 6. We are going to learn how to analyze a business using nothing more than add, subtract, multiply, and divide, and what we've learned about financial accounting. 7. We will look at a company from the standpoint of a banker. Would the company qualify for a loan? How much? 8. Is the company operating efficiently? What areas are in need of improvement? 9. Is the company's stock fairly priced? What will improvements in performance of the company do for the stock price? 10. This is a highly sophisticated analysis. It is on par with what Wall Street analysts use to evaluate a company. 11. Rather than just define the ratios, we will be examining a real company and use the ratios. We think this collection of 5 videos on ratio analysis is really exciting stuff. We are going to apply what we have learned thus far in this course. We will use ratio analysis, calculating 24 ratios, to develop an examination of the company. That's right. We are managers. We are investors. We are analysts. We have a powerful set of skills. We are learning the language of business in this collection of 5 videos. We are going to categorize ratios into 5 types shown here. They are 1. Liquidity ratios. 2. Leverage ratios. 3. Profitability ratios. 4. Efficiency ratios. And 5. Investor ratios. For the purposes of this ratio analysis section, we are using financial statement standards as they apply to a clothing wholesaler in the United States. Every trade association has financial standards based on the type of business. They vary based on the business and the country you may be living in outside of USA. In this slide, we see the statement of financial position for the ABC company. In the asset section, we have $350,000 in current assets. Assets that will be converted to cash or consumed by the business in the current year. Fixed assets are $300,000 with contra assets. Accumulated depreciation of $40,000 on buildings and $25,000 on equipment. Total assets of $650,000. Current liabilities are liabilities that are due in the current year or accounting cycle. Here the list is long. Accounts payable, accrued expenses, wages payable, sales tax payable, unearned revenue, balance on credit line, current portion of long-term debt, and warranty reserves for a total of $150,000. Long-term liabilities include an equipment loan and mortgage payable for $175,000. Total liabilities, $325,000. Now we have the equity section. Common stock, $50,000. Additional paid-in capital, $50,000. Total contributed capital, $100,000. Retained earnings beginning, $155,000. Current earnings, $35,000. Less dividends, $15,000. Equals $175,000 retained earnings at year end. Total capital is $275,000. Total liabilities and capital, $650,000. Accordingly, assets do in fact equal total liabilities and capital. Here we have the statement of earnings for the ABC company. Sales are $940,000. Beginning inventory is $120,000. Purchases are $660,000. Added together, goods available for sale, $780,000. Less ending inventory of $160,000. resulting in cost of sales of $62,000. Gross margin is $320,000. Administrative expense, $115,000. Marketing, $123,000. Depreciation expense, $16,000. Total operating expense, $264,000. Income before interest and taxes, EBIT, is $56,000. Interest, $11,000. Taxes, $10,000. Net profit, $35,000. Just looking at the financial statements does not tell us much. However, using ratio analysis will reveal a great deal of important information. Here we have a subset of the financial statements. Total current assets, $350,000. Cash, $35,000. Marketable securities, $10,000. Accounts receivable, $130,000. Less allowance for doubtful accounts, $7,000. Inventory, $160,000. Prepaid expenses, $12,000. Deposits, $10,000. For a total of $350,000. Here we have fixed assets of $300,000 and total assets of $650,000. A building, $275,000, less accumulated depreciation, $40,000. Equipment, $90,000. Less accumulated depreciation, $25,000. Total fixed assets, net of accumulated depreciation, $300,000. Total assets, $650,000. Here we have current liabilities. These are liabilities due within the year or accounting cycle. Accounts payable, $60,000. Accrued expenses, $10,000. Yes, accrued expenses are a current liability. We have used a service or bought a product, but have not yet paid for it. Wages payable, $10,000. Sales taxes payable included. Unearned revenue, $10,000. That's a liability. We received payment, but must still deliver the product or service in the current period. Balance on credit line, $30,000. Current portion of long-term debt, $10,000. That's the principal repayment due this year, whether on a mortgage or equipment loan. Warranty reserves, $10,000. If we sell a product or service, we may offer a warranty. Consider a car manufacturer that offers a warranty, 3 years or 30,000 miles. The sale happens this year, so we charge this year's income statement for 1/3 of the cost. The rest goes to future years. Total current liabilities, $150,000. Here we have an equipment loan of $30,000. Mortgage payable, $145,000. Total long-term liabilities, $175,000. Total liabilities, $325,000. Here we have total equity of $275,000. Contributed equity, $100,000, as identified in a previous slide. Retained earnings, $175,000, also accounted for earlier. Here we have sales, $940,000. Beginning inventory, $120,000. Add-in purchases of merchandise inventory, $660,000. The sum of both are goods available for sale is $780,000. Subtracting ending inventory of $160,000. Cost of goods sold equals $620,000. Gross margin, $320,000. Operating expenses, $248,000. Administrative expense, $125,000. Marketing expense, $123,000. In this slide, we have taken depreciation expense out of operating expense. We arrive at income before interest, taxes, depreciation, and amortization, EBITDA, $72,000. EBITDA is not recognized by the Financial Accounting Standards Board, but it is a meaningful metric of cash flow from operations used on Wall Street. Deduct depreciation, $16,000. We get EBIT, or income before interest and taxes, $56,000. Deduct interest, $11,000. We get income before tax, $45,000. Deduct taxes, $10,000. Net profit, $35,000. Notice, from this slide forward and in all future slides, we are assuming that all account numbers are in USA dollars.